My name is Jeff Brown, and I've been involved in these kind of programs, in fact, in delivering educational programs to the financial services sector for over 20 years. And I joined the BTRM a couple of years ago. I'll talk a little bit about the BTRM program after Jill and Michael deliver their pieces, just to give you a very kind of brief overview of what this program is about. But in the meantime, I hope you find this session really useful, and I will pass you on now to Jill Cetina.
Yes, hi, thanks. My name is Jill Cetina. I am a professor at Texas A&M University, work in our commercial banking program and in the finance department, and also a member of BTRM faculty and our North America chapter director. Before moving to A&M, I've held prior roles in bank supervision, both at the OCC and at the Federal Reserve Bank of Dallas. I was an officer with oversight for areas related to balance sheet policy. And I was also a key member of the Moody's US Bank rating team. I was associate managing director when we had some of the challenges involving US banks in the spring of 2023. So very pleased to be part of BTRM. I think that the work of this program globally is super important. And I'm going to have Michael, who's one of our colleagues, introduce himself, and then we're going to get right into the program.
Thanks, Jill. And just my introductions, I'm Michael Kodachi. I'm excited to be part of working with BTRM. Jill and I are involved in a North America group, and Jill is leading the group, and lots of participation from both US and Canada. My career is that I've spent my entire career in Treasury, whether in a direct Treasury role, also in a CFO role, kind of still leading Treasury. I have a deep passion for the whole area of Treasury and how it relates to your day-to-day management and individuals that are in Treasury roles, and how do you learn, how do you grow. I've had the benefit of being involved in a number of different educational programs throughout my career, and they were real stepping stones that allowed me to progress in my career. So through the BTRM program, that's exactly what you get. You get a great opportunity to learn, enhance your skills, and it's driven by individuals that have been actually involved in Treasury management. So they bring not only the educational components, but also bring a lot of practical insights. And you will hear that from both myself and Jill today. So with that, I will turn over to Jill.
Thank you, Michael. And again, so pleased to discuss this with Michael. So we're going to start off first, Michael and I, talking a bit about why, from a North America perspective, banks investing in themselves and strengthening their Treasury functions is super important. And we're going to talk about that. And then after Michael and I make some remarks along those lines, we're going to turn to kind of an overview of what BTRM is for the candidates and faculty, just a thumbnail of what the BTRM curriculum covers. Again, we have a lot more detail that's available on BTRM's website about any of these things, but as well as how the course is structured and how it's helpful to financial institutions. But my hope is that as we move into the beginning of this presentation, where we talk about kind of the current macro environment that banks in North America and indeed globally face, people will recognize that investing in yourself and in improving your bank's Treasury function is foundational to success. That's my sincere hope that people will, if they weren't already convinced of that they will be after this presentation. So with that, if we could turn to the next slide, we're going to talk a little bit about some of the things that are going on in the US. So if we could advance to the next slide, please, Jeff. Thank you. So as some of you may know, I write a monthly newsletter for BTRM, and basically since January, I've been flagging the risks to U.S. growth slowdown. And this was before it was, I'll say, fashionable or consensus. It's starting to become, I would say, more fashionable this week. in the market to recognize this. But you can see what I've got depicted here is just, some of the nowcasting that are done by the regional feds, Cleveland Fed. In terms of the inflation nowcast, we've got inflation still above target, but coming down. And then the Atlanta Fed GDP nowcast, really a very significant decline in the current contemporaneous forecast for where U.S. growth is. You can see at the bottom, I've also in this chart depicted that, basically since we had the transition in terms of the administration, that we've actually had, consensus U.S. macroeconomic forecasts mark up GDP growth as opposed to down. But why do I believe that, we are going to see and in fact are seeing some of the slowdown, signs of slowdown? First is that we've got a negative fiscal impulse that is coming from the policy changes of the current administration. And that relates to, as we've all seen, the DOGE initiative, which is affecting, of course, federal workers, but it also affects federal contractors, federal grantees, and in general, federal payments, and has created uncertainty that's much broader than the federal workforce with regards to federal spending. Second, I will say, kind of channel to weaker growth relates to the changes that are happening in the United States regarding immigration. And, different people may have different views on this topic, but I think when we look at workforce growth, which is a key driver of overall economic growth in the United States, much of that workforce growth has come from immigration, in the last few years. And so when we slow immigration down, when we slow workforce growth down, we will also slow economic growth. Relatedly, immigrants, of course, when they're in the U.S., they consume goods and services. So when we have fewer immigrants, that's just necessarily a drop in aggregate demand. But these are kind of two prongs that very powerfully relate to the economic outlook. And then the final prong that I would highlight is economic policy uncertainty. If we were to throw up a chart of that, and the goal of this isn't to present a blinding array of charts, but just to kind of talk about the thematics. Basically, economic policy uncertainty is at 9/11 type levels in the United States right now. And we had, of course, the consumer confidence data come out this morning, which showed a dramatic weakening in consumer confidence that was outside of any forecasts that had been anticipated. So I think for these reasons, again, negative fiscal impulse, the impact of immigration on demand and also on economic growth that is basically kind of baked in the cake, and then economic policy uncertainty. These are all reasons that basically since January, I've been expecting a growth slowdown. And that growth slowdown is going to have implications for banks in terms of their CECL models, right? The forecast that they use when they think about, what they should be doing in terms of their allowance. So these are not just kind of more general topics, but things that banks need to be kind of thinking about. We could turn to the next slide, Jeff. Okay, so this is a chart of some data that, basically came out on Friday. And this is University of Michigan, expected changes in prices in the long run over the next 5 to 10 years, which is depicted in yellow. And what we can see from this chart is that basically the most recent survey showed a dramatic increase in long-run consumer inflation expectations. So this is something that, the Fed has got to be very mindful of, right? Because the de-anchoring of inflation expectations is one of the things that can, for lack of a better word, pose challenges in terms of, the central bank being able to credibly ease policy. So basically, again, at 3.5%, which is where we are in terms of the most recent survey from Friday for UMich, you would have to go back all the way to 1993, I believe it is, to be at that level of long-run inflation expectation, which is, of course, meaningfully above the Fed's 2% inflation target. When we look at the UMich consumer sentiment, which I have here in the white, you can see at the same time that we had, and that was kind of presaging what happened today in terms of consumer sentiment. But this survey basically also showed a very significant month-on-month decline in US consumer sentiment. So again, the consumer is both anxious about consuming and worried about the inflation outlook. If we could turn to the next slide, please. So I think the point of this slide, and I'm going to acknowledge Torsten Slock, who likes to put out very impactful charts in his daily briefings, but from Apollo, who's the chief economist. But I think this is a lovely chart that sort of shows how, if one were just using kind of what is priced in terms of U.S. interest rate futures, people sometimes also use, of course, the forward curve, that those expectations have fairly consistently been wrong. If one is well read on the literature with regards to, forward curves, one knows that these are unbiased but poor predictors of future rates. Yet it is often common, I saw this when I was at Moody's, for banks to think that the forward curve is what they should manage their bank to. And I see Michael chuckling as I'm saying this, but this is super important and something that is part of the curriculum that you learn not to do, and is a source of a lot of woe to people beyond banks, but in particularly in the banking sector, when they, have, I'll say, a poor grounding in how to think about the interest rate outlook as they manage their bank. We could turn to the next slide, please. This is the data that is up through, Q3, and I put a little call out for Q4, but basically shows unrealized securities gains and losses for U.S. banks. And what we can see is that, up through Q3, there was a notable improvement in unrealized gains and losses, which worsened again in Q4. Obviously, the move in the 10-year yield has been lower lately, so that's going to alleviate some of the pressure here. But I think the point still stands that, a number of institutions, both during my time at Moody's, which was, of course, when SVB failed, but even subsequent to that, have had challenges in terms of effectively managing their rate exposure. The use of HTM in this environment to park a lot of long-dated securities when it basically, forestalls one's ability to hedge interest rate risk is I think, a real challenge and concern, and is something that people should approach with great caution. Okay. I'm going to talk a little bit as I wrap up.
Sorry, Jill, we've got a hand raised by Race.
Sure. Yeah, Race. Sorry, I didn't see you. My apologies. Did you have a question?
So, Ed, how do you want to do this, Jill? Do you want Race to type in the question?
Her mic is not working.
Ed, can you unmic Race, please?
Oh, you were just sending a thumbs up.
Apologies.
Okay. All right. So, my points here, and I'm going to talk a little bit about my longer run view, which I, in terms of rates, when I get towards the end. But my view is that, use of HTM, because it forestalls hedging and it makes us, I'll call it, not nimble on rates, is something that I would be very reticent to do. So in any event, and as some may have seen recently, there was a nice piece in American Banker in which Mike Mayo called out some U.S. regional banks that have, I'll say, kind of fallen back into some of the SVB's type patterns of how they're managing interest rate exposure. Okay. So if we could turn to the next slide. All right, I have talked about this in my most recent February column, basically that stagflation risks, are rising. Obviously, I've been saying for some time that I've been concerned about growth, and I think the question is, how extreme some of this becomes, and whether it start to become in feedback loops, say from financial markets to the real economy that cause this to, for lack of a better word, accelerate. Also, whether any of my Fed colleagues, again, because of the inflation data that I just showed in terms of the UMich long-run inflation expectations being so elevated, perhaps decide to sit back a little bit in terms of reacting to any type of growth slowdown. So I do think that this is how we could end up with some of these risks manifesting. So just to speak about stagflation, at the risk of, speaking to a group of bankers, so this is probably obvious to all, but this is one of the most negative scenarios that banks can face because it involves the manifestation of credit risk. Interest rates are not coming down, and potentially liquidity risks as well. And we in the United States and in many advanced economies don't really have much historical experience with this because as advanced economies, our central banks have not had inflation challenges for decades and have been able to credibly lower policy rates when the macroeconomy weakens. This is more of a, I'll call it developing banking sector phenomena, something that happens in developed economies to their banks. But what the data and the research from the International Monetary Fund shows is that, the level of banking stress and loan losses in economies that experience stagflation, again, mostly developing from their research, tends to be much higher. We don't have data from the 70s. Most banks don't have that data. We won't be able to credibly model the losses. But, we already have, as you can see from this chart here, which is basically using data about non-performing loans as a share of total loans by different loan categories in the United States. We already had for a number of loan categories a worsening of NPLs, okay? And so now we've got on top of, I'll call it that momentum in terms of rising NPLs, we've got this growth slowdown coming. And I was just checking this morning before this webinar, we have not yet seen a move in high yield spreads in the corporate bond market. That to me would be, even more of a sign that we have some significant bank and credit stress coming on the horizon. Again, not happened yet, but something to watch. As I mentioned in the call out here, we've had very significant loan modifications in commercial real estate. And this has actually been a factor that's helped depress non-performing loans in that area. But it has come at a cost for the banks that have done it, usually in terms of a net income, which is, of course, their first buffer against loss. So we could turn to the next slide, please. All right, this is a busy slide, and what is it that I want to convey? If there's maybe a happy piece of news in my presentation, it's what we got from the January FOMC minutes. And the January FOMC minutes seem to suggest that the Fed is thinking about potentially doing a pause in terms of quantitative tightening. This is a topic that I lecture on. I lecture on unconventional monetary policy and its impact on bank, funding, and bank liquidity as part of the BTRM curriculum. But what am I trying to show? Okay, first, in red, this is the Fed's total balance sheet. And you can see the COVID period where, as a result of QE4, basically the Fed's balance sheet just increased significantly. The Fed's balance sheet is funded by a number of different liabilities. The green is banks' reserve balances at the Fed, which are the Fed liability, and our bank's assets are part of U.S. Bank's liquidity buffer, right? And you can see that rose very nicely and dramatically. You can also see another component of the Fed's liabilities, which is the overnight reverse repo facility, which is in teal on this chart. And that rose dramatically with the Fed's balance sheet. And this is basically kind of a little bit, of the important thing here, because this teal line has helped buffer, since SVB's failure, has helped buffer banks from the decline in Fed liquidity, and also what happens in terms of when the Fed's balance sheet shrinks, it can have implications for US banking system deposits. And I've shown banking system deposits here in the white line, which you can see that they were growing with the red line, again, the Fed's balance sheet, and then began to shrink as the Fed started to shrink its balance sheet, as SVB began to fail, okay, in early 2023. And it was the decline in money funds holdings at the Fed, the teal line, that helped offset what the Fed was doing, okay? So this teal line is about tapped out. There's very little left in terms of these money fund balances at the Fed. If the Fed continues with QT, the risk would be that banks again face deposit pressures and liquidity pressures. So I'm very pleased that my colleagues recognize this and are stopping this. Hopefully, they will be announcing this at the upcoming March FOMC meeting. This will be welcome relief. But I anticipate that this, that they may announce this as a pause and as something that they will ultimately, once debt limit and whatnot is, for lack of a better word, done, that they will finish. So this is my one piece of good news, but I would say longer run, what I look for in terms of US rates is that we are going to have a growth slowdown that is induced by, again, the three channels that I alluded to already: negative fiscal impulse, the immigration issue, and then economic policy uncertainty affecting consumer confidence in business fixed investment, okay? And I think in a sense, this is perhaps not unwelcome on the part of the administration. Why? They would like to term out the US Treasury market. They would like to do so at lower rates. A deceleration in the economy may facilitate both the Fed lowering the Fed funds rate, as well as a lower 10-year yield, which they have said is their objective. And I think the other thing that it facilitates from the new administration's economic policy agenda is it facilitates later this year a discussion of tax cuts. So the point of tax cuts brings me to the observation that this is going to be, there's the potential for very significant yield volatility here. And so for a bank to think that, it's going to just be a typical rate cycle, whatnot, I would strongly encourage people to stay very nimble, very liquid in their balance sheet. I think that there's a lot of economic policy volatility here on fiscal and monetary that could potentially be in the offing. So with that, I'm turning it over to you, Michael.
Thanks, Jill. And maybe before I jump into my slides and get going, I think I want to acknowledge a couple of things. One is I've actually had a good opportunity and a good time to meet with Jill over the last month, and really appreciate her deep insights coming from both, having been in various Treasury roles, and then also having just that broad understanding of what's going on in the U.S. markets. Sometimes it can be overwhelming. A lot of us look to that as a leader, and really appreciate Jill's insights that she brings, because not only is she looking at the yield curves as most treasurers are, she also has that great background around, what are the things that are going to move in various directions. And really, I just want to acknowledge, Jill, your great insights and the things that you bring to the table. As we kind of move into some next stages, I really want to give a bit of a outlook on where we are right now in the context of the Canadian economy, and kind of bring that in perspective as the programs around how do individuals such as yourselves that are on the call and others that might be looking at this later, how do you navigate your role as a treasurer, and what are you looking at? How do you draw from various clues in the market, and what does it mean to you in the context of your role and quite honestly your bank, and where are you? Where do you operate? Do you operate in multiple jurisdictions? Are you a small or mid-sized organization and very much more of a regional player? And so our goal here is really to help you navigate through your day-to-day focus points, what you're looking at, and also as you look to the program as well, how does the program strengthen your general understanding as you continue to progress in your career. Further to that, what I would say is, as Jill was speaking to earlier, we see volatile times ahead, and there's a lot of volatility. There's a lot more unknowns. Jill and I have been around since the early 2000s, having been through some financial crisis. We've also been through periods where mortgage rates were very benign and very low, and every month we would run different forecasts and nothing really would change. And now we're into a period really since 2020 through COVID, and now through rapid increases in overnight rates, really a time and a period where markets are extremely volatile. And so there's a lot of attention that treasurers need to be paying to both liquidity and to their ALM risk, and thinking about where you are and how to position your balance sheet for coming changes that you're really not sure in which direction they might go. So recognizing that, I want to speak a little bit about Canadian economy here, and what we see is through the last 2 years, yield curve has been inverted, and that's had an impact on many mid and smaller organizations that don't really have robust hedging programs. And so a lot of the brunt was borne in that through margin declining, and really a time that's been particularly challenging for many institutions. And what we see right now is that obviously the curve is starting to kind of at least get to flat. But that comes off the back of the fact that interest rates went up rapidly, the overnight interest rates, and those rates have now come back down. But further behind that, the driver behind that is the fact that the Canadian economy has worsened over the last 6 months. And what we see is, as a result of that, is the Bank of Canada had to cut interest rates 50 basis points twice consecutively, just to kind of start to draw back and bring things back into perspective. So it's against a backdrop of a worsening economy that we actually see the yield curve starting to normalize again. So it is ironic when we think through it that we had rapid increases in interest rates to slow down the economy. Now the economy is slowing down and actually starting to fall back. Obviously, we've seen interest rates kind of come back in line, but a lot of volatility that's played its role in there. As we go forward, and we look forward at least over the next 6 months, even over the next year, even in the next 1 month, obviously many considerations that are under play, as many of you will be aware of from local news and around the world. Tariffs are coming. We're not sure if they will be, if it will actually bear out. However, that is playing in on the economy already. You're already starting to see organizations make decisions or put things on hold, or people be uncertain around what their next decision is as a way to see things play out. So a lot of this does start to have an impact, whether it's actually real in terms of tariffs be getting imposed, or as Jill spoke to earlier, there's really this consensus around really looking at where interest rates have been, and will this start to place pressure on bringing rates back down? So obviously lots of things to consider. What I've found through my career is always paying attention to the trend. So the trend is always indicative of what's kind of going on out there. Starting to look at it, as we can see on this particular chart, clearly the trend on the yield curve peaked back in 2023 into late 2023, and since then it's come back quite significantly. I would say right now on this particular chart, the 10s versus 2s, we kind of probably pretty much in a flat range right now, and we'll look to see where the curve goes over the next couple of quarters. Jeff, if we can move to the next slide. So just quickly over here, I want to speak about, what you'll find is obviously on a regional level, there's always some specific nuances that might be taking place. And what we're seeing in Canada is we see many mortgages renewing over a 2-year period. And a lot of this, we could go back, and I'll show you in the next chart. A lot of this relates back to COVID and mortgage refinancing that took place. And what we've termed the terminology is referred to here is the mortgage renewal cliff. And so in the context of Canadians, Canadians can choose different term products, and most of them choose a 5-year fixed term mortgage. And what that does is it locks in your rate for 5 years. So even though your mortgage is over 30 years, you can lock in a rate for 5 years. And many Canadians tend to go fixed for 5 years. And so this is represented in the green bars on the chart in front of you. And just what that does is it starts to put a lot of pressure on banks, thinking about, as these mortgages come up for renewal, just what is the right decisions. There's often a lot of conversation that goes on in papers and news articles. Should you be going 5-year fixed? Should you be going floating? Should you be going 3 years? But the general trend is many Canadians are in the 5-year fixed space. And so that has a lot of implications on a bank's balance sheet, and really trying to understand, what is the best way to think through this. Where are likely your clients going to go? And obviously from an ALM perspective, what we start to think about is how many of these people will renew back into 5 years? Will they go into 3 years? Will they go floating? So many questions that start to come up around your own modeling, and just really where are consumer expectations. And I found in my experience, a lot of the consumer expectations are driven heavily by newspaper articles, experts on what to do. So Jeff, if we go to the next slide. So this is where we get a bit more practical, and we start to think about, the BTRM program, asset liability management, and really thinking through in the context of real life experiences. If you are in a bank today, you're in a treasury role, and you're starting to think about this mortgage cliff coming, what I've done here is I've shown you the 5-year bond. So the 5-year fixed mortgage rate and the 5-year bond are highly correlated. They move together, they move in unison, and there's a certain market spread that's always there. It's where a lot of the securitization programs are active users of the 5-year bond as well. A lot of debt the government issues in order to fund mortgages are issued in the 5-year space. So it's a well-known area, highly liquid. And what we see on the chart in front of us over here is really thinking through around, if you were in a role where you got to think about hedging, what kinds of thoughts are you going through today? And how are you starting to anticipate what could be coming? We have a number of headwinds in Canada. So we definitely have tariffs. The economy's been moving sideways for the last 6 months. We also have a federal election coming up with a new prime minister. possibly on the table. And then we've had an ongoing issue around affordability. So we do have a number of headwinds in Canada. And what we could see is we could see bond rates fall quite dramatically, or we could see bond rates go up. And so part of thinking through the BTRM program and getting into asset liability management is really around taking all of these pieces into consideration, looking at your profile, looking at your duration, and then starting to think through what is my strategy and when should I start to be hedging and how do I go about that. And that's one of the things I do like about the program is it speaks to that, and it speaks about how to give consideration to different things that you're going to face in real life. So with that, that concludes my side of the presentation, and I'm going to hand back to Jill or Jeff.
Superb. Thanks very much, Michael, Jill. Those were great insights, I have to say, and very eloquently explained. So thank you very much. I hope you found that very useful. I'll just briefly talk about the BTRM program, so when I joined a couple of years ago, one thing that I made it my mission to kind of call everybody around the world who had done the program, who had completed the program. And my objective at the time was to find out what improvements could be made on the program. These conversations, it was almost unanimously exceptional feedback in terms of how useful this program was. And so that was thrilling, to be honest, at the time. And so if you are thinking of potentially enrolling onto this program, and you want to find out more about it besides the next few slides, and you want to speak to somebody who's completed the program, or to several people who've completed the program, then send me an email, and I will send you, a list of people who you can contact. My email address, I'll just put down here. There's one of two email addresses. I put it in the chat. There we go. And so what is the BTRM program actually about? Well, as Jill mentioned earlier, ALM is foundational to banking. So it's a 6-month program designed to empower individuals working in every aspect of bank balance sheet, risk management, and ALM. And that sums it up very well. That's really what the program is all about. It's been literally designed by practitioners, led by Professor Murad Chowdhury, who's spent many, many years as a practitioner, and famous author in this space as well. I'll talk about him very briefly in a second. And he's basically handpicked his faculty from over 10 years ago. We're in our 11th year now. Jill happens to be one member of faculty. We have lots of different members of faculty, over 20 members of faculty actually. So the range of expertise is huge. And the emphasis really is on implementation and practical relevance, practicality. This is not only designed by practitioners, but it's specifically for those working in this space. That's what it was designed for junior members right up to very, very senior members who've enrolled onto the program, many over the years. So if you want to speak to senior, very senior bankers, you're more than welcome, and I'll put you in touch. If you want to speak to very junior bankers, you're more than welcome, and I'll put you in touch. The senior bankers, they have their own reasons for enrolling onto the program, but they also found it very useful. And what tends to happen is they then put their team members through the program because they realize how practical and useful it is. Trying to change onto the next slide. Let's see. Okay, so it is legitimately a global bank treasury program. We have delegates from over 60 countries, and I think these profiles are really important as well. I am going to send this slide deck to you all so you can review the slides, and also to check out the appendix, which has very important slides, including the syllabus itself. I'll send this deck to you either later today or tomorrow. But especially the student profiles are really, really relevant to this program. So if you are working in one of these areas, or in one of these roles, I should say, then the BTRM program is incredibly relevant to you. These are some of the employers who put their employees through the program. I mean, all the big banks especially, and the medium-sized and smaller banks put delegates through this program, and these are some of the names. There are also, banks from, you've got DBS there as well, and European banks and African banks. So it really is an extremely wide range. There's a question for you, Michael.
Carry on, Jeff. I will take a look at it.
Sure. Good. Right. So this is the BTRM faculty. Again, they're all specialists in this field, but within their own particular expertise. Top left-hand corner, Professor Murad Chowdhury. I'm sure you've all heard of him or maybe read his books. And just to give you a glimpse of some of the faculty members. So Murad himself, he's headed up treasury departments all over the place. JP Morgan being one of many banks. He's also a consultant to many global institutions. He's a best-selling author. Amongst other books, the one he's very famous for is Principles of Banking. And if you haven't read Principles of Banking, please buy Principles of Banking and read it, because it's an incredible book. He's an extraordinarily eloquent human being, brilliant at explaining complicated concepts in very simplistic terms. He's also a fellow of the Chartered Institute for Securities and Investment, a fellow of GARP, the Global Association of Risk Professionals, a fellow of the Institute of Directors, and a freeman of the Worshipful Company of International Bankers. He's an incredible character. For those of you who do watch any of his webinars or lectures, or any of you who have met him, he is a bundle of energy, an incredible guy. And his deputy head of faculty is Dr. Edward Bass, an American guy. He's been a banking and credit risk professional for many years in New York and London, served as head of education for the CFA Institute in Europe, Middle East and Africa as well. And he's also on Premier's Ethics and Professional Standards Committee. We have also, I'll take you through two more actually. I'll take you through, so Peter Eisenhard, many of you may have heard of him. He's extremely well known. Peter Eisenhard is Secretary General of the International Council of Securities Associations. He's worked in treasury, money market trading, bond options trading, repo, credit, debt origination. And he's worked all over the world, New York, London, Tokyo. His career spans over 30 years, and he's a past chairman of the International Capital Markets Association. Professor Jessica James holds a DPhil in atomic and nuclear physics from Oxford University, which is a somewhat different topic area that she's studied to what you would be studying on the BTRM. She's author of Handbook of Foreign Exchange, Interest Rate Modeling, Currency Management, and Random Walks in Fixed Income and Foreign Exchange. These are just some of the names of the faculty, and there's a lot of other names there who you will probably know of as well. What does the BTRM cover? There are 5 key course modules, and these are the titles of each module. Module 1, Asset Liability Management. Module 2, Bank ALM Operating Model and Risk Management Governance. Module 3, Strategic ALM and Financial Markets. Module 4, Liquidity Risk Management, ILAP, Asset Encumbrance and Funds Transfer Pricing. And Module 5, Bank Capital Management, ICAP, and Stress Testing. And again, in the appendix of this slide deck, you'll find a breakdown of the syllabus.
Hey,
so
Jeff,
yeah.
Jeff, can I jump back in and just to answer the question, and then we can carry on? So the question that was posed came from Laurent, and really he was asking if in Canada, if individual clients decide not to go for 5 years and instead, at 5 years fixed, instead they want to go 3 years, or they want to go a variable rate and lock in for 5 years as a variable, or just go 3 years or 2 years, what impact does that actually have on positioning your balance sheet? And so there's an interesting question. What we have seen over the last 3 years, which is probably the first time I've seen in my 20-year career, a lot of individuals in Canada started to go into 2-year mortgages and 3-year mortgages terms, which has not often been the case. And a lot of people did that because they anticipated interest rates to come back down. So instead of going 5 years and locking in at 6%, they went into 2-year and 3-year products. So what I find and what we've seen is that as interest rates come down, individuals tend to still stick with 5 years regardless. So while we have seen some movements every now and again, as the long end of the curve comes down and that opportunity presents itself, the path for many individuals on a conservative basis generally is still going 5-year fixed. So despite many different opinions and thoughts in Canada, people like the conservative component. They like knowing what their payment is going to be for the next 5 years. Generally, individuals like that certainty of that. That said, if they did move more into variable rates, what impact that would have on your balance sheet? It would shorten. You're right. It would shorten the gap. It would make assets and liabilities a lot closer to each other from a ALM perspective. That said, I've seen very few organizations actually get that right, and I've seen few actual clients at banks, regardless of the size, whether it be small, mid-size, or even large banks. We haven't seen many people. We haven't seen many balance sheets that were kind of leaning towards having a lot of their clients in variable rates. Variable rates tend to be somewhere in the range of 20 to 30% of the balance sheet. Fixed rates tend to be 60 to 70% of the balance sheet. So there is that skewing. That skewing tends to be there quite a bit. And really the question around what comes up a lot then is really your question around duration, and where do you feel your duration needs to be. I am anticipating that as banks move through the next year, they will lengthen asset duration, and that will likely start to create some challenges for the balance sheet, especially if interest rates do go down substantially from where they are right now. You'll be locking in a lot of asset duration at the low end of the interest rate cycle. So again, lots of food for thought there, but and that's really the value of the program. And as Jeff was speaking to a little bit earlier, how do you consider some of those issues? What are you modeling? Have you, one of the things I've learned as well is really have you modeled kind of your worst outcome, your worst scenario, given thought to how you might anticipated that? I don't think I've spent much of my career thinking through some of those pieces. It was always kind of thinking through the preferred path, but lots to consider, I think, as you look at your own organization and where that might go. So back to you, Jeff.
Super. Lauren, I hope that was a satisfactory answer. It certainly seemed to be very satisfactory. Thanks very much, Michael. So the BTRM journey, well, it literally starts here. So it's an information gathering exercise. We're recording this session as well. So, if you want to review what's been discussed about the program, you can. If you decide that you want to register for the program, which begins on the 9th of April, then you complete an online registration form or send me an email and I can send you the form. The admissions team usually confirm acceptance or otherwise within 3 working days, but it's usually very, very prompt. It's usually within hours, actually. And then you will get a primer on banking, which brings everybody up to speed for the start of the first module. You receive a full set of course materials and textbooks before the start of the program. And then you start the program. 5 modules, each lasting approximately 1 month. And it's the same as many other online educational programs nowadays. They may be delivered live, as this one is. And then you can watch online from around the world, or you can watch the recordings. If you're working, you can watch the recordings of those lectures. There's an online test at the end of each module. In fact, I think on the next slide, yeah, this is really how the program is structured. An online multiple choice test at the end of each module. There's a 3-hour exam, which everybody does at the same time at the end of the program. So you do it on your desktop, and then you need to get 60% or higher to pass. And in fact, that's also the pass mark for each online multiple choice test. However, this isn't a case of if you fail, that's it, you're expelled from the program. No, it's these multiple choice tests are for us to track really how you're progressing. And if you're doing, if you do get a low mark, then that's when we come into play and we find out what areas you're weak on, and we help you to ensure that your knowledge and skill set is up to speed in order to move on to the next module. So we try to help as much as possible from that point of view. 60% or higher to pass, 80% or higher, you get a BTRM distinction, and the highest mark in that final exam entitles you to the Wiley Award, which goes to 1 person each cohort. There are 2 cohorts every year, so the one starting on 9th of April, the next one after that begins in October. And I should also tell you incidentally about the BTRM forum. This is a phenomenal part of the BTRM program. It really is. The BTRM forum has 2 elements to it really. One is for you to be able to ask questions throughout the program, which are answered by faculty very promptly. But the other, and I think this is incredibly valuable, is that it's a space for you to be able to network with all the other individuals across the world studying on the program. And it's a space where you're able to share news items, to share opinions. It's a little bit like a WhatsApp group. But it is the BTRM forum, and it's a great way to share all of your ideas with others around the world, and how your region differs from other regions across the world as well. Okay, I won't. So the appendices, just to give you an idea. So you've got module 1, module 2, module 3. These are the different modules. I'm not going to take you through these right now. I think what we'll do, these are some of the books as well, the testimonials, which you can go through if you want. These are the certification and accreditation of the program. And I think now is a great time to ask whatever questions you would like to Jill, Michael, and myself. Vishal. Okay, so I think, Jill, you may want to help me out with this as well, but I think, yeah, BTRM is certainly right to deepen your ALM skills and reposition you as a risk leader, without a doubt. And incidentally, as an FRM holder, you're also entitled to a discount. So, Vishal, what I'll, if you want, in fact, if everybody wants to send their email addresses to me, if you're interested in receiving the slide deck, and also if you have any questions, then send me an email. But Vishal, what I'll do is I'll send you an email to let you know what the discount is for FRM holders. And what I'll also do, in fact, just to give you an idea so, of how this would help you to transition, is I'll send you a copy of the student guide. And the student guide is an incredibly comprehensive and detailed breakdown of every module of the syllabus. It's very detailed indeed.
Jeff?
Yeah.
Maybe to just further answer Vishal's question as well. I think, you know, what BTRM, I've seen BTRM, the way it helps various individuals. I mean, if you think of treasury roles, they're sometimes difficult to come into. So, you know, either you're going to start as a treasury analyst and you can progress your way up through roles, and you have the good fortune of starting at the bottom and kind of progressing. Alternatively, education is going to be a way to get something behind you that then puts you in a position that you strategically placed, that when a new opportunity comes up, whether it be at a manager level or the director level, that you're well positioned. And so part of that challenge is that often people will either ask for experience or education, one of the two. And so, you know, BTRM offers that educational component that starts to strategically position you.
Thank you, Michael. Thanks very much, Aaron. Any other questions?
Jeff, I think Jill had an answer there as well.
At the moment.
I don't think I'm hearing Jill.
No. Jill, for some reason, you're not on mute. I can see that, but for some reason, we're not hearing you.
Still no?
Try again, Jill.
Still, I think, Jeff, we've got a question about where the BTRM is recognised. Well, Jill tries to work out a microphone.
Yeah, so there are many from the Caribbean who go through this course as well. So you're more than welcome to contact alumni from the Caribbean. So Zita, if you want to send me an email, I'll send you a list of alumni. And incidentally, this isn't, I don't pick and choose which alumni to send. So if you're from any particular country and you want to enroll and you want to speak to alumni from that country, I send you the lot. Okay, because there's I'm confident that they all found the program useful. Also, yeah, so it is recognized in the Caribbean as well. No problem. Any other questions? Okay, so I think, look, in the coming days and weeks, there might be questions that pop up. Feel free to send me an email. You can also, if you want, give me a call, and I'm available on this number. It's a number in France, as it happens. You can reach me on WhatsApp in order to keep the cost down to a bare minimum. And look, I hope you found this useful. I really do. And Michael and Jill's presentations I found really interesting. I hope you did too. And as Jill said, thanks very much, everybody, for joining.